The Fed holds steady for the first time since July, but what comes next? The Fed hit pause on interest rates on Wednesday, signalling little urgency to restart cuts after 3 contentious meetings. Chair Powell struck a cautiously upbeat tone, pointing to firmer growth and early signs of a stable labour market. But is the Fed declaring victory too early before political pressure starts to bite? Jeremy Stretch is Chief International Strategist at CIBC Capital Markets. So Jeremy, what was your main takeaway from this meeting? Was this a clear hawkish tilt, and does it effectively rule out further cuts under Powell?
Well, certainly it looked like Chair Powell was relatively relaxed regarding the policy narrative after that aggressive policy easing that we've seen over recent months. Now, of course, we know that Chair Powell has just 2 more meetings to go, and it did look like he was quite keen to see out the end of his term without necessarily adjusting policy further. But I think despite the adjustment in the balance of risks, it is very much the case that it is going to be an evolving data backdrop, which will prove to be pertinent. And I think we shouldn't lose sight of the fact that we do continue to have dissent amongst the Fed board, including Christopher Waller, who is, of course, one of those 4 final candidates for the Fed chair role. So, yes, it's the case of the risks have diminished in terms of immediate action, but I think the data will be the determining factor as we go into those final 2 meetings of Powell's tenure.
Let's look closer at that data, and job growth has slowed sharply over the past year, yet unemployment has stabilised, a dynamic that Powell called challenging and quite unusual. So how does the Fed navigate that trade-off from here?
Well, yes, that's right. It is a very difficult backdrop to navigate in terms of the accuracy of the data. And certainly, I think the policymakers, not just in the US, but I think in many jurisdictions, are very mindful of uncertainties in relation to the accuracy of employment data. But it does seem as though we're in a low hiring environment. And I think that's quite important. So beyond just the headline non-farm payrolls releases and or the unemployment rate, which of course is susceptible to changes in employment participation, I would also keep a close eye on the underemployment dynamic, because I think that may also prove to be a pertinent indicator of a relatively subdued labour market, which may ultimately prove to be influential in terms of the Fed policy narrative even before the end of Powell's tenure.
Well, Powell did call the inflation story quite positive. Are tariffs being downgraded as an inflation risk?
Well, of course, we have been waiting for the full impact of tariffs to come through, and we haven't yet seen it in the same magnitude that we might have anticipated. But I think we are seeing some of the disinflationary dynamics in other sectors also proving to be impactful. So it may be the case that even if we do see some degree of tariff-related pass-through, it isn't going to really drive headline inflation substantively higher, because we're seeing moderations in things like owner equivalent rent. So it may be the case that inflation expectations are going to remain relatively well anchored. And that is, of course, good news for the Fed, not only for Chair Powell, but potentially for whoever his successor is as well.
Well, let's talk about the successor, and BlackRock's Rick Rieder has emerged as a leading contender. Would that appointment significantly shift the easing narrative?
Well, it's interesting that he has proved to be something of an outsider in terms of his candidacy, and it was certainly a significant uptick in terms of poly market pricing at the beginning of the week. It does seem as though his candidacy has waned just a little bit, so it's a closer 3-horse race, and Mr. Waller's poly market pricing has certainly increased after the recent dissent. But I think the presumption would be that if Rieder were to become the Fed chair, it would be a relatively dovish interpretation. And perhaps that was one of the reasons and catalysts, alongside some of those Trump comments earlier in the week, which really facilitated that significant deceleration in dollar performance, or retreat in dollar performance, that we've seen over the course of the last couple of days ahead of Mr. Bestant's interjection yesterday.
Well, of course, the recent moves in the dollar have resurfaced the debasement fears, despite the administration's reassertion of a strong currency policy. So how vulnerable is the greenback looking?
Well, of course, the strong dollar narrative goes all the way back to 1995 and Robert Rubin. And the question is this reiteration an attempt to try and drive the external value of the dollar higher, or is it more about trying to alleviate some of the downside risk and to preclude market presumptions that the US administration is quite happy to tolerate a very aggressive cheapening in the dollar? I think the problem for the US is that if it encourages a cheaper dollar, then it does risk further amplifying the debasement trade, and US treasuries are no longer perhaps seen as that risk-free asset that we've historically seen. So I think it's an attempt to try and limit pressure in terms of selling in terms of US treasuries, because, of course, that is one of the key things that Mr. Besant is mindful of if he regards himself as the nation's top bond salesman.
That was Jeremy Stretch from CIBC Capital Markets. Don't forget, you can watch more videos on Reuters.com.